Hey, it's Mike. I'm not an investing guru. I'm an average guy sharing my investment journey on the internet. In today's video, we're discussing investing in TSLY for the last 9 months using margin. These are the results. This type of investing is called income investing. And one of the main pillars is to create a side stream of passive income using this margin. So ideally, you build a nice safe foundation of high quality stocks and ETFs, and then you can borrow against that to create a side stream of income. So then you can use this money to either invest in more stocks or pay some bills with it or whatnot. One of the key pillars of this strategy is to invest in an ETF or stock or holding that can pay more than you can borrow. So if you are getting 61% in distributions every single year and you're borrowing at 8%, that is a really good amount. There's another position I added QQQY. This pays out 55% a year. Again, same thing goes as the last investment. As long as it pays more than you can borrow, that's something that I want to put into my account. So this is my portfolio, $147,000. The bulk of this portfolio is invested in Tesla. I've just recently stopped investing in Tesla, and I have been putting my $125 weekly deposits split between VTI and VXUS. So what I've been doing is I've been investing $60 in VTI, $60 in VXUS, and then just setting aside $5 extra just as cash to cover like the Robinhood Gold, as well as just kind of stacking a little bit of a cash position. In this section right here, my margin status is low risk. I have about $83,000 buffer before I get margin called, and I only utilize about 10% of my portfolio in margin. So I've borrowed $17,414, and this is a safe amount of money. So my TSLY position here, total market value is $16,319. You can see I'm down here $11,000. Thing about this is it is correlated with Tesla. Tesla has not been performing well, so therefore this will not perform well. There's one component that I want to add to this conversation is a lot of people see the performance of Tesla and they see that it's down 40%. They're like, oh my God, this is a terrible holding. You know, it's not making any money. I'm going to leave. That is a terrible mentality to have, because the fact that it's going down is the best time to invest in it. Because once Tesla share price recovers, what's going to happen is if the share price goes up, implied volatility goes up, and therefore the dividends payout will go up. So, you know, if you're buying TSLY at a cheap price and then Tesla's recovering, we're going to be getting bigger and bigger payments every single month. The fact that it's been on the downtrend the last 3 months, it's still paying a good amount of money while downtrending. Once it goes up, we're going to even get more and more income. So when people are here panicking, oh my God, I'm just going to invest in NVIDIA and whatnot, that's not the thing to invest in, because that's already hitting all-time highs. What you want to invest in is the thing that's going low. If you invest in the thing that's going low, then once it recovers, then you're going to have huge income and a really good cost basis. Continuing on, you can see the margin requirement for TSLY is 25%, and we'll discuss this in the next section. And this is obviously all the holdings, which I'm not going to discuss too much, but what I want to talk about is the payment, $811.31. So I had 1,000 shares of TSLY, paid 81 cents, so $811.31. For investing in some sort of dividend holdings, that is incredible. And then, just as I mentioned earlier about the QQQY, investing in TSLY is a covered call strategy, and investing in QQQY is a cash secured put strategy. They're essentially both the same thing. You're banking that the stock price will go up over time, which most likely most of the stock market over time increases. So what you're doing is when you invest in TSLY, if the share price goes up, then the implied volatility goes up, premiums go up. If the share prices go down, then technically for a cash secured put, the premiums will be higher, therefore increasing payments. So to have both of these, you have a covered call strategy and a cash secured put strategy, is a good thing to probably have in your portfolio. So you're, diversifying your type of strategy. Even though they're very similar, they're slightly different. Moving on to the investing portion here. So let's just go over. So it says the portfolio value is $164,000, but it subtracts the margin amount. Once that margin paid back, then that's what my portfolio value will be. So you can see here that I'm utilizing about 10.56% of margin, which is a pretty safe area to be using margin. Also, what I wanted to talk about is in terms of really good portfolio strategy, you shouldn't be investing more than 10% of your portfolio in any type of option investing. So by me borrowing the money and investing in option income, 10% is a good number for both borrowing money as well as investing in an option style strategy. If you're putting 100% into like an option style strategy, is not the best type of strategy to do. You can see here all my holdings. Tesla again is down, as therefore the Yieldmax will be down. Not concerned. I've been investing in Tesla for 4 years. The price oscillates all the time. Nothing new. People are in favor of Tesla, then they're not. It just oscillates back and forth. Continuing on, the margin used here, and then my margin maintenance number is $62,000. So if you remember how I mentioned TSLY has a 25% margin requirement, if I borrowed $100,000, the margin requirement would be $25,000. If I want to do that, I can borrow $100,000 and then it would reflect only $25,000 on this margin maintenance. So this would put it at $67,000, or excuse me, $87,000 in margin maintenance. And then I would not be margin called until it would hit under that $87,000. But you can see here, I'm in a really safe amount. Like my portfolio would have to drop down to $62,000, and you saw that it was at $147,000. And then you can see here just my unpaid interest is accruing, and then just the Robinhood Gold. Yeah, continuing on. Since my last video, there is an extra section that I added, and that is this portfolio yield in this top left corner. So what this stands for is prior to expenses, taxes, and reinvestment. This is the monthly yield, so 2.92%, which comes out to 35%. So essentially what I did is I took this number divided by the amount that I paid, gave me this number annualized for 12 months. So you can see here, price paid for all my income investments, and that's counting QQQY as well as the TSLY, $27,737. Margin amount, $17,414, which is 62.78%. So about 38% of this money is already paid for, not borrowed. And probably by the next month, it should be under 60%. As you can see here, $811 was paid out. And this is the calculation I did for how much would I anticipate the expenses to be. This is counting Robinhood Gold as well as the interest. Moving on, usually what I do is I set about 30% of the income in taxes. I did my taxes last month in February, and the majority of the distributions are taxed under something called return of capital, or it's like non-qualified dividends or something like that. If you actually look on your 1099 sheet, and essentially what it meant was that until you hit your cost basis back, you're not going to pay taxes on it. So for last year, I set aside $750 for taxes. Since I didn't hit my cost basis yet, then I was able to utilize that money that I set aside to pay down the margin a little bit quicker. But once you hit your cost basis, then it's short-term capital gain. So what I'm doing here is I want to just account 30% here, set it aside. If I use the money, great. If not, then I could use this money for whatever I want if it doesn't get taxed. But once I hit my cost basis, I just want to set it aside just so that I'm not caught in like a compromising position. And it's just a good habit to set the money aside. And then here, 25% reinvestment, so $202. So what I've decided this last month was that I'm going to cut this in half. So 50% I'm going to invest in TSLY. The other 50% I'm going to invest in that QQQY. So again, you're investing in a cash secured put strategy as well as a covered call strategy. And $101 went to TSLY, $101 in the QQQY. And then here you have your net gain. So right now, after your reinvestment, taxes, expenses, I am left with $248.49. With this money, you can do whatever you want. You can buy cheeseburgers with it. You can reinvest that money back into the Yieldmax funds. What I'm trying to do with the extra money is try to pay down my margin a little bit faster. Then you can see here, my monthly yield is 0.9%. And then the portfolio boost, I have my account is about $146,000. You take that number divided by this number, gives you a portfolio boost of 0.17%. And over the long run, if you can squeeze out an extra 1 or 2% over the S&P 500 using the margin, then therefore you will outperform the market. And 1 or 2% goes a long way in 20, 30 years. All right, looking at these numbers, income value, 16K, price paid, 27K. We're still in the red. Tesla's not doing well. Once Tesla recovers, we will recover some money here. Total income that I've gotten investing for these last 9 months has been $5,200. You can see the expenses here. $670 almost. Taxes for this year is $781. Base reinvestment was able to invest back in $1,300, and the net gain $1,952. So a couple thoughts for a bunch of us watching this. We're kind of curious to see like if this income keep going up, as well as have, some capital appreciation. Investing in TSLY, we've been seeing the negative side of investing in a covered call style strategy. The dividends are good. Once Tesla recovers, that will be the true test. See if this is really like a really good investment to continue investing in. Because if Tesla's rocketing up and then the payments, dividends are rocketing up too, and then you're getting your performance back, then this would be a really good thing to invest in. But just like I said in the earlier portion, like you shouldn't be investing more than 10% in a covered call investing style strategy. Anyways, one of the reasons that I like investing in this TSLY fund is because I used to sell covered calls on Tesla. I used to make a lot of money. It is much easier to invest in a fund like TSLY. You can scale it much easier. And another factor is pretty difficult trying to figure out how to roll calls and options. When you invest in a fund like TSLY, you invest into like a fund manager, and they're the ones that are doing all the work for you. So you are building a side stream of passive income where you don't have to do anything. Some people say real estate investing is passive. It's not. Owning rentals, you're fixing things, you're cleaning toilets. I think this is the truest way to build a side stream of passive income without doing any. A couple other thoughts. We're paying the margin down slowly. We have good amount of income coming in. The tax situation is pretty good. We've got that squared away last month with the return of capital. We're just seeing if it's still viable and to see if the price is going to perform. And then at some point, we'll see how that QQQY does, and that's going to be something we're going to be monitoring going forward. Just want to show you my thoughts, share my journey with you guys, and if you guys have any questions, definitely ask in the comment section. But besides that, y'all have a good one.